Hi guys, welcome to the Monday morning message for chapter number 14, health insurance. This is actually one of my favorite chapters to cover. Over the course of my career, I've had to, in 20 plus years, had to not only use health insurance as a patient, but as a direct patient care allied health member, have to work with patients' insurance in order to get things covered, like lab work and immunizations and that type of stuff. And so you get fairly well versed in what health insurance is, how it works, different mechanisms within health insurance. It is very complicated, so I'm going to keep this fairly short and just cover some of the key points. So we'll go ahead and kind of skip around a little bit on the PowerPoint. When we look at health insurance today, there are various sources. Most of you guys know that, right? The majority of people have private health insurance. Typically, most people get that through their employer, and it's whatever the employer contracts with. So some employers may have multiple plans that you can pick from. Some employers may only have one plan that you can pick from, and you either take it or you don't. That's what most people get their insurance through when they're working adults. As we age, then we move into, Medicare. And for those that can't afford private health insurance, maybe the unemployed, maybe lower income, that we have the Medicaid options. In California, it's called Medi-Cal, but that's Medicaid. And there's differences between Medicare and Medicaid, which we'll cover a little bit in here as we go along. Okay, so we've already hit the employer-sponsored health plans. Okay, obviously this year we know that the Affordable Care Act, affectionately known as Obamacare, has been under fire recently. Some of the mandates in it have been removed, and some are potentially up for removal in the current election cycle. So don't want to get too much into the Affordable Care Act at this point, just because not quite sure what's going to shake out with that. Okay, so some of the terminology, health insurance. Let me ask you the question: what does health insurance cover? Well, health insurance is designed to prevent you as a patient from having huge financial losses due to some healthcare expense. That's what it's for. For most of us, that's exactly what it does, right? If you think about the average cost of a office visit in the United States, it's roughly around $83 to $90, the average visit for any office visit that you have with your primary care physician. Okay, so right around $90. If you're somebody who has a chronic condition that is being managed by a physician over and over and over again, where you make several visits to the doctor's office, $90 starts to add up pretty quickly. So if you just think about that, if you were going, basically once a month, you're approaching that, $1,200 a year just in office visits if you didn't have insurance. Okay, so think about, adding something on like a knee surgery or a mole removal, some type of minor office surgery, or you have some acute illness that causes you to have to go into the doctor a lot. This can add up pretty quickly. So health insurance is designed to protect you against those huge financial losses. Terms like member, subscriber, the insured, those are interchangeable terms. That means basically whoever is paying for that insurance, whoever is covering the premium. So say, for instance, you get health insurance through your employer, then you have a contract with that insurance company and you become the member, the subscriber, or the insured. And that could also be like for children, the insured might be the child, the policy holder is the parent, okay? So the children become dependents of that policy. Okay. I'm going to focus on probably the three main terms in here in the middle of this slide: deductible, co-payments, and co-insurance. A deductible is if you have a deductible type insurance, which many people do, Basically, what that requires is anything outside of routine care, you have to pay out of pocket before the insurance company will pick that up. So things like your routine office visits, you may pay a copay. So the copay is dictated by the insurance company, not by the doctor's office. So let's say for every office visit you have a $20 copay. You're obligated to pay that. Then the office typically bills the insurance for the remainder, okay? If you have a deductible, usually you're still going to do that part of it, that routine care, the routine office visits, immunizations, physicals. You're going to pay that co-payment. The insurance will pick up the rest. But things that are outside of normal, right? So something like, say you need an MRI on your knee because you hurt it. That's not something that's standard or routine to get MRIs, and MRIs are expensive. So that would fall under your deductible, which would require you to pay for the MRI. Most insurances that have deductibles will have a yearly maximum amount. So let's say your deductible is $3,000 a year. Once you hit that $3,000 threshold out of your pocket, then the insurance company will start paying just like it would on any normal visit. Okay. Co-insurance is a little bit different. Some people have co-insurance insurance plans, and basically that would be like an 80-20 plan or a 70-30, which means that if you have that type of insurance, a co-insurance, then the insurance company will pay 80% of the bill, you pay 20%. Or if it's a 70-30, they'll pay 70% of the bill, you pay 30%. That would be a example of maybe a co-insurance. Okay. We don't need to worry about pre-existing conditions at this point. That is still part of the Affordable Care Act mandate, but that is one of the things that has been up for discussion to possibly remove that mandate. Exclusions are exactly that. It means it's excluded from coverage. So it would be something that you don't have insurance coverage for. Okay, and so it's very important that if you're a policyholder that you understand your policy. It's really not up to the doctor's office to know what's in your policy. It's up to you, the policyholder. It's a contract between you and the insurance company. So I highly encourage people to read their insurance contracts, try to understand them as best as possible. Before you have anything done, you should either read your policy or contact your insurance company and find out if it's a covered benefit or if it's excluded from your coverage before you proceed, because that will make a difference on whether you want to get something done or not, depending on the cost, right? Okay, let's see here. I'm going to find a couple other things that are really important. Managed care plans, to kind of talk about this, managed care plans were created. For the most part, they kind of started in the early 1970s, and they've gained a lot of acceptance, and most of the plans that we're involved in as employees are probably managed care plans. These were designed in an effort to try to control costs. So basically what happens with a managed care plan or a managed care organization is that organization puts a lot of services under its own umbrella, and that is a way to try to minimize costs by having more control over what is offered to patients as far as their healthcare plan is concerned, and who has access to that. So, for instance, something like Kaiser, if you don't carry Kaiser coverage, then you don't get to utilize Kaiser services. Okay, so that is a way to try to control what that plan is actually giving out as benefits to those policyholders. Okay, so probably the two main types of plans would be HMOs and PPOs. Now, the way I typically would tell you the difference between these two organizations in a very general sense is to say HMOs, health maintenance organizations, usually what happens as a patient is you will pay a lower monthly premium, but your services will be much more tightly controlled. and dictated by the health insurance plan. So the example of that would be something like if you needed referrals to go to a specialist. If you needed a referral from your primary care physician, then you probably have an HMO. Now, normally that's dictated on the insurance card as well. It'll say that it's an HMO or a PPO policy. So HMOs for the patient lower monthly premiums that you pay in order to have the insurance, but there's tighter restrictions on what you can do as a patient without the insurance company's approval. A PPO is kind of opposite. A PPO, Preferred Provider Organization, gives you more freedom. So usually your monthly premiums are going to be higher, but you have less restrictions on how you can use your insurance. So you may not have any referrals required to see a specialist. So if you tweak your knee, instead of going to your family physician and getting a referral, possibly to a specialist, you could go to a specialist immediately without going through that referral process. So a PPO offers you greater freedom. What I usually tell people, you've heard the old adage of money doesn't buy you happiness. Money buys you freedom. It buys you the freedom to be able to do things and move about this world in a more leisurely manner. And that holds true with health insurance. If you can afford a PPO, then you are paying for more freedom in your healthcare choices. If you can't, then you're choosing an HMO, which can limit things or make things possibly a little bit longer to get to, more hoops to jump through to get to things, but you pay a little bit less for it. Okay, so hopefully that makes a little bit of sense and helps you understand the difference between the two, just kind of in a general sense. Okay, COBRA is quite interesting, especially during this particular period of time in our history. COBRA is Long-Term Consolidated Omnibus Budget Reconciliation Act. We just call it COBRA. COBRA is designed for if you are let go from your employer, the employer by law has to offer you up to 18 months of health care coverage. The catch to that is that you are no longer, because you're not employed, so you're no longer technically in the group. So because you're not in the group and you're just kind of on your own, right? You're unemployed and you're on your own now. You're not part of the employee group at your workplace. You will pay a much higher monthly premium. And honestly, it seems somewhat crazy, doesn't it? That you're no longer employed, you're not collecting a paycheck, maybe you're collecting unemployment, which is typically not paying you 100% of your wages, but they want you to pay, twice as much for your health insurance premium that you were paying when you were employed. So a lot of people don't take advantage of COBRA because it becomes too expensive to do. However, the law requires that employers offer this to you, and then you have the right to accept it or decline it. Okay. Let's see. Individual health insurance policies. These are policies that you, as an individual, purchase from an insurance company. Typically, these are going to be much more expensive because, again, you're not in a group of 1,000 people in your workplace that are paying premiums every month. It's just you. So usually this is going to be a very expensive option to health insurance if you are doing this on your own. Say if you're self-employed, this would be, so a lot of people, what they'll do is they may get a very basic coverage package. It doesn't include things like major medical expenses and hospitalization care and that type of thing, because this can be very, very expensive to get individual policies. Flexible spending accounts, I have one. I like it. It's pre-tax money that you get to set aside specifically for healthcare cost savings. So many employers are offering this as a benefit of employment, where they'll take out, before taxes, they'll take out a preset amount of money. So let's say it's $1,500. Let's say you want $1,500 a year taken out, put into this flexible spending account so that you can use that for things like co-pays and prescriptions and any medical costs. This actually saves you a little bit of money because it's pre-tax. So that $1,500 they took out of your paycheck, the government didn't tax that. Okay, so you're getting to use 100% of those dollars that you earned for medical expenses. So I usually say if you can afford to do this, this is actually a cost savings. Over time, it's probably going to save you thousands of dollars in taxes by doing this. But it's a wonderful way to kind of save a little bit for those healthcare costs and not feel that pinch every once in a while when maybe you have something that happens acutely and you need to access healthcare more frequently. This is a good way to pay for some of those expenses. Okay. Elective procedures not covered. Yeah, insurance policies typically have exclusions. They usually have things that are not covered, and typically those are elective. An elective, for all intent and purpose, basically means that if you don't have it done, it's not going to harm you. So something like cosmetic surgery. Usually cosmetic surgery is an elective function because it's to do something to improve possibly the way you look or the way you appear, and it may not be medically necessary. If it's not medically necessary, your insurance company typically will not cover it. It'll be excluded. Okay. Prescription drug coverage, most insurance plans will have this. Okay. Medicare. When you turn 65 years old, you are going to sign up for Medicare. In particular, you're going to sign up for Medicare Part A. Okay, so there are 4 parts to Medicare. Okay, Medicare Part A, hospitalization coverage. So at 65 years old, you're going to sign up for this. This is Medicare is a federally funded and run health insurance. And you're going to sign up for Part A. Most people will also sign up for Part B. Part B is your standard doctor's care, your provider coverage, physician services, things like your standard routine office visits. That would be covered under Part B. Most people will get that. So the majority of people that have Medicare typically have Part A and Part B. Part C is Medicare Advantage plans, and those are in addition to those are, I just lost the right word for it, but those are supplemental plans that you can purchase to kind of beef up your Medicare coverage. And then Part D is the prescription drug plan. Okay, and Medicare was started back in 1965. It's been around now, going on 55 years. It's very well accepted. The majority of people that have Medicare actually enjoy their Medicare coverage. Medicaid, again, this is state funded or state run. It has to prescribe to certain federal guidelines, but all states have a Medicaid plan. Again, in California, it's called Medi-Cal. We gave it a nice, cute name. And these are typically health benefits for low-income individuals that either can't afford to participate in private health insurance or don't have jobs that offer private health insurance. This is a way to get coverage. In particular, Medicaid really tries to cover people like pregnant women and young children. Because obviously young children don't have a choice in their health insurance options. It's typically up to their parents. And if you have a low-income household, this is a good way to make sure that the children are getting their routine exams and their immunizations. Okay. TRICARE is for the military. TRICARE is a federally funded program, that benefits families of current and retired military personnel. I know plenty of people that have TRICARE or have had TRICARE, and they enjoy it. There's also a TRICARE option. I believe it's still called TRICARE Prime, which allows military personnel to not have to see doctors on military bases. They can see private physicians out in the community as well. Okay. CHAMP-VA is the Veterans Administration benefits. So this is for people that have had service-related injury or illness while they were in the military. Then they get CHAMP-VA, they get the VA healthcare benefits. Okay. Automobile insurance, that's a good one. Typically covers patients' medical expenses. Some states have different requirements for this. I know where I came from in the state of Colorado, you used to be able to have automobile insurance cover certain things that happened during an automobile accident, and that is no longer the case there. So I always like to look at each state's laws pertaining to automobile insurance and whether it can be used or not, or whether there's any health benefits on it. Okay. Let's see. Disability insurance is for, in particular, most of us can get short-term disability, oftentimes through an employer. You can get private policies like AFLAC. So here's a good tip for you, AFLAC. AFLAC has many different types of policies, disability policies. They have a cancer policy. I have that, which covers almost any type of cancer that you might get. There's health insurance benefits for that. In case you can't work your job or whatever, you can file claims with AFLAC. Disability, there's two different types, essentially. There's short-term disability and long-term disability. And again, a lot of employers offer this as a benefit of working for them. It typically will cover, lost wages, health related, anything related to the disability. Then this insurance would typically cover that. Okay. Let's see. The Universal Claim Form, I like this one. It's called the CMS 1500. This is used by all health insurance, including Medicare, Medicaid, workers' comp. It is a universal claim form. Back in the old days, every insurance had their own claim form. So if you worked in an office that took 20 different types of insurance, then you would have 20 different claim forms pertaining to each one of those insurance companies. That just doesn't make sense. It's not very efficient. So that was changed quite a while ago. So we have one claim form that's used to document whatever we're billing for and send that to the insurance company in order to get paid. So we use that one claim form. Rejected claims typically are processed because there's not correct information on the claim. It could be the policy number doesn't match that patient. There isn't any diagnosis codes on the claim form. There isn't any procedure codes on the claim form. So usually rejected claims don't have enough information on them to process the claim by the insurance company. And the majority of us can rectify that fairly easily. When the claim is rejected, then we can submit a new claim or update that claim and then ask them if they can, if they'll go ahead and accept the claim now. Denied claims are when claims just aren't paid. These claims, the reasons for denials, they vary. They can be for not having enough information. They can be because the information just doesn't match or it's inappropriate. Oftentimes, denied claims are typically because a patient's insurance doesn't cover whatever we billed for. It's an excluded item, and we billed for it. The insurance company checks that all out and says, hey, we don't cover this. The claim is denied. Okay? And if you ever have issues or problems with insurance, then it's advisable to contact the state's insurance commissioner's office, and they can give you advice on how to proceed with any kind of a claim, any kind of complaints about potential insurance abuse. Okay, so that's it, kind of in a nutshell. I tried to keep that as short as possible. So that's health insurance, chapter 14. Please make sure that you read the chapter completely. If you have any questions, feel free to email me, and I'll be happy to answer those for you. And I look forward to seeing you guys for next week's Monday Morning Message.